Welcome back, everyone, to the mid-March HFRX Performance Snapshot with Ken Hines, President of HFR Index. Welcome, Ken.
Thanks for having me on.
So, Ken, give us a kickoff of what March has looked like so far.
The volatility which characterized the end of February accelerated in the first 2 weeks of March with significant declines across US focused equities, really led by declines in technology. Markets really digested and positioned for what the impact of the tariffs would mean for the overall economy and for individual profits. The good news is that hedge funds have weathered and navigated this intense, extreme volatility very well. So you're seeing defensive outperformance of the hedge fund industry in the first half of March. We can see here that the declines of US technology equities about 6% in the first 2 weeks of March. And it was more than that if you really think of it from the top level. Fixed income based relative value arbitrage has only declined about 1/3% in the first 2 weeks of March. Similarly, for event driven, which, as you know, is a mix of credit and equity special situations. And then, as you can see here, we have a decline of about 0.75% for the HFRX Global Hedge Fund Index. And we saw a decline of 1.2 and 1.3% for macro and equity hedge. Equity hedge, as you know, is the most directional, the most exposed to these trends.
And drilling down, Ken, how does it look at the sub-strategy level?
Yes, we do have one sub-strategy that's actually been positive in the first 2 weeks of the month, that being equity market neutral. There's a certain intuition behind that because there's strategies that are equally long and short, so pretty much protected from the volatility and the downward momentum that we've seen across equities in the first couple of weeks. Similarly, though, with a little bit more directional exposure, we have relative value multi-strategy, which you hear a lot about credit multi-strategies and funds like that. This area has only declined about 1/4% which is pretty impressive for the 2 weeks when you've seen such intense volatility impacting US equities. Similarly, equity special situations, which is a reasonably high beta directional area of the hedge fund industry, has only declined about 1/3% versus the decline of nearly 6% for technology equities. And then finally, merger arbitrage. So you have obviously credit oriented, market neutral, and credit oriented, event driven strategies and relative value multi strategy, really the four leading areas.
And have the March losses eroded away the composite performance year to date?
We've seen some change in leadership and the drivers of performance. So, really, 2.5 months into the year, we now see the leading area is the fixed income based relative value strategies, which includes credit multi strategies, those posting a gain of about 1.3%. Similarly, event driven, which has a lot of overlap between relative value arbitrage, a little bit more equity exposure, I would generally think, and a little more A exposure in the event driven space, but still inclusive of the March decline, the late February decline. We're looking at a decline of nearly 8% for technology equities. And here we have a gain of 0.75% for the HFRX event driven. The overall global hedge fund index gain of about 0.5%, again, through this very turbulent 2.5 months. Equity hedge, even with the sharp decline that we've seen, still positive on the year, about just about 18 basis points. And then macro, really the lone area of the four strategy areas, which has declined, that's only declined about 70 basis points thus far in the first 2.5 months of the year.
And how about at the sub-strategy level year to date?
Yes, I think we're seeing a mixture of the trends from March and as well as the trends from the first 2 months of the year. Leading area of performance has been market neutral. It's certainly intuitive with equal long and short exposure that area has done well through this period where we've seen intense volatility and we've seen dispersion widen, a gain of 164, as a matter of fact. about 1.6 in fundamental value. And obviously, those areas were strong in January and the first part of February. So even with the last month of volatility acceleration and negative performance in equities, you're still positive there for hedge funds in the fundamental value space. A lot of that is in the financials. Financials were very strong in February. They've come off record highs there, nearly 1.5% in merger arb. Again, even with all of the economic concerns about a slowing economy, I think people start thinking more about the M&A opportunities. I think we're going to see a strong M&A cycle there. And then finally, relative value multi-strategy was a leading area through this volatility in the first couple of weeks of March, and is a leading area for the year of about 1.3% for the RV multi-strategy credit-focused funds.
All right. Well, excellent. Thank you for joining us. I encourage you to visit HFR.com, create an account to receive regular updates on indices from us. We have insights and commentary on the website and much more media content. You can also download the Investor Guidebook, which features several use cases for the indices for institutional investors. And please email indexdata@hfr.com or Ken Hines for more if you have inquiries. Thank you.
Thank you for having me on.